Hey, everybody. Welcome to All Things Litigation Funding. My name is Ted Farrell. We have probably one of the top 5 or 6 guests in the history of the program today, Cindy Chen Delano. We're going to talk about a lot of interesting stuff. But first, how about just Cindy, a quick background, and then we'll get into it.
Great to be here. Thanks for having me, Ted. All things litigation finance is super interesting. And I don't know if I deserve the top 5 or 6. I think of myself as just a participant in all of this. I come to this
I'll do the rankings. I'll do the rankings on this podcast. All right.
There you go. But my background, I started as a lawyer in private practice, as a restructuring lawyer, over 20 years ago now, and primarily as a debtor creditor lawyer for many years. And then making my way to the buy side when I started seeing opportunities. And I think the most important aspect of my journey is I like having skin in the game. I don't like being a mere participant or a passive sort of bystander. For me, I love the way investing works. And so that's how I became an investor in the last 20 plus years as a former recovering lawyer.
Interesting. Okay. So then let's forget it. So when was the first time you saw a special sit or distressed that had a litigation component? Like, tell me sort of like the one, and again, like, which one do you remember? Did you work on? But like, when was the first time you saw, where litigation or even not even litigation, but even, a company held a legal asset, right? Like, when was like the first time that kind of like connected for you, or like early ones you remember?
Yeah, so I think the first time all of that sort of intersected really was around 2016, end of 2016, 2017. And I remember this because it was right around, around the holidays. It was the Peterson deal that Burford brought to market. And so, as you may or may not know, but Peterson was filed for bankruptcy because of a litigation claim that it had against Argentina. Burford ended up purchasing it and then prosecuting the claim, the true form, the original litigation funding. Um, the case, I guess, took a lot longer than they had anticipated. And so one of the ideas was, well, how do you de-risk a portion of it, during this time and create a secondary market? And so that's when I started looking at that secondary transaction, worked alongside of other funds to help structure that. And that's where the intersection of special situations, the need for liquidity, as well as litigation financing and understanding claims and how to price value these risks and how to think about an ultimate realization there. That was the first time I looked at litigation funding and finance as a claim.
Interesting. And so you were looking at it as a potential participant in a secondary.
That's right. A secondary market. So you had to also sort of create that secondary market and think about the instrument that would otherwise trade in the secondary market. So borrowing, for example, ideas on, how do you create units? How do they trade? And that's something that litigation funders don't really think about, because primarily they're lawyers that think about, well, I'm going to bring a claim. I'm going to get damages.
I follow-ups on this piece because that's a big thing. And I'm one of those too, so I get it for sure. So tell me this. So I know that you are a former practicing lawyer, but I know you did a lot of corporate deal stuff and litigation stuff. So it seems like you kind of got to use the litigation hat on, is this going to win? When's it going to win? But then more importantly, and I think something that a lot of people in the business talk about, because look, most people come in the business were like me, they had been almost exclusively litigators. Right. And it's great because you can underwrite risk of litigation, but at some point we have to move to finance. So it's interesting sort of using, kind of putting both those together.
Yeah, I think so. And I think the way I look at sort of my career is really along the way, I collected a whole bunch of tools, right? Sort of tools that you use to invest. And part of those, it's how do you value claims? So having a little bit of litigation from working as a bankruptcy lawyer focused on some of the litigation aspects of a case. As a bankruptcy lawyer, looking at credit and collectability and enforcement and claims and priorities and what happens at the end. As a in-house, attorney at AIG Investments, where we had to restructure a whole bunch of securitizations and think about what happens when securitizations do not work, and you have to repackage those up for purposes of capital markets and regulatory capital. So I think it's a little bit of everything.
So it's a little more complicated than a breach of contract case and saying these are the three elements under Virginia law to collect. You're saying there's a little more to this than just understanding litigation?
Well, I think, yeah, it's a little bit, definitely a little bit more. I think it's a component of understanding the finance, the drivers of investments. I always think, when people think about investing and what it is, and they call litigation asset as a asset class, ultimately it comes down to, investment 101. You put a small bag of cash down. How do you make that small bag of cash into a large bag of cash in the shortest time possible? I mean,
Right.
that's what the role is. And in doing so, you have a lot of tools that can help you think about it. For example, the structuring. How do you buy something? The valuation of something. You don't buy, not all claims are the same, and claims that are going to pay out much later in the future. You should probably price it so you have, time to actually get to realization, and they should be discounted for that present value of what the claim is today, for how long it will take you to realize that bag of cash in the future.
Right. And I think that one thing, and we're just sort of, it's November now, so there's been a lot of just great, funding conferences all over the world. And there's a lot of discussion about duration, right? And that duration has really been a key driver in some of the difficulties that, certain funds are having that, they have a case, it looks good on the merits, but it just is taking longer. So the underlying of, we still feel strong on the merits and we still feel strong on the damages, but it is just taking longer than even our, look, we went on Lex Machina before the case started and we thought, oh, we'll be at a trial in 18 months, and now it's year 5. So tell me, as someone who is doing structuring, how much sort of these duration hedges kind of play into putting something together that's investment grade, not just optimistic litigator grade.
Well, I think those two aren't different, right? When you think about, so let's take a step back. When I think about litigation grade versus investment grade, I don't think that they're even, sort of mutually exclusive. The way I think about litigation is, when you invest in a litigation, it's the same as any investment where it's a credit investment. What is at risk? What is my capital at risk? What am I getting compensated for that risk? And then how do I know I'm going to realize on the returns, right? The realization. And that time frame is the duration that we're talking about. And then at the end of it, when you realize, if your assumptions are a certain way, all of a sudden you can run the math and say, I did great because, in that short time frame, I delivered excess of, 20% returns, where it's similar to equity as opposed to just credit.
Right.
So I think, going back to your question, right? Like, how do you think about duration? I think ultimately, for me, I come to it as, well, what is the litigation? How do I actively manage to a realization at time certain? If I'm extending a loan that is a loan, say, TED PLC, TED as the litigator, and I bought your loan, I'm lending you, funds on account of your law firm, and you have a bunch of cases, and you expect to pay me off in 4 years. So that type of risk, the question I have is this a risk to TED as a law firm, as a credit risk? What is the time frame that I expect to track? And so I need to make sure that it gets done in that time frame. Like, if you're supposed to pay me back a fraction or 20 to 30% every year, I should expect that you're on target to do that. And then, separate and apart from that, I also need to make sure that there's nothing that's going, sort of outside the guardrails. So, when I think about litigation and structuring it, it's got to be consistent with what the risk premium is. And then, two, all the things that you underwrote to get there, it should be happening. And if there are things that are going sideways, then how do you get it back on track? And is there something that you need to re-underwrite? And is there a repricing that's necessary? So that's the duration risk, I think, that a lot of lit funders were just starting to learn, which is, Just because someone tells you something is going to happen, it may not happen. And that's something that is very common and is a lesson that's learned in the distress investing credit world. So we're used to foreclosing, we're used to enforcing, we're used to monitoring, and we're used to restructuring.
Yeah, it's sort of interesting because you know, when dealing with funds that are mostly former litigators, they could re-underwrite the merits a million times because they are that smart, and they see things that no one else sees. And then when I deal with people who come from distress, they make the call relatively early on the merits, right? Yes, there are defenses, right? And we don't think this is defense is going to win, but it's there. But if we're going to make the investment, then the time is spent on the structure and the guardrails to make sure that even if it goes poorly, and not because the case isn't good, but like, we draw this judge who tends to take 3 years to trial, but doesn't set a trial date, that you can kind of structure for that. That's really interesting. So let's get back to, I want to talk a little bit more. You mentioned about bankruptcy. And so I'm a bankruptcy trustee and I have sort of valuable claims. I'm surprised that there's not more litigation finance in bankruptcy from and I know you've been in sort of bankruptcy distress situations. So what does this tool do? Like if I called you to be the bankruptcy trustee of a huge, retailer that had Visa, MasterCard claims, stuff like that. Tell me sort of about like how, you know, this can be levered to deliver what you're supposed to deliver, which is money back to the creditors.
So I think those, if you think about litigation claims, there's a lot of value to it, right? So the question then comes down to, going out there, selling those claims versus funding those claims and getting to a realization and looking for sources of recovery on account of those claims. Like, how do you turn a claim against a defendant into cash, and how fast can you turn that claim into cash? And that's the role of a litigation bankruptcy trustee. And so when you look across the board on across bankruptcies, not, you know, when you have folks that are sort of the trustees, they may know, for example, how to reduce inventory into cash, but they don't know how to reduce the claims. So I think of it as it's not too dissimilar than someone who's really good at, liquidations. They should be likewise good at liquidating claims into cash. That's litigation finance.
Right. And I think that those ones are interesting because, the the sort of typical pejorative lobbying discussion is that litigation finance creates, frivolous litigation. And of course, when there is a bankruptcy, there is a litigation that has started, right? And it was not started by a litigation funder. So there are lawyers involved. There is a litigation saying there's not enough money to pay everyone. And so, I'm interested in your thought about whether, how hollow that kind of rings, at least in a bankruptcy situation.
So I think that one, I disagree that litigation funding is what's spurring frivolous litigation. Ultimately, I think that's a false premise because litigations, the U.S. is a common law system. It is a litigious society by nature because that's the system that allows us to sort of right wrongs and sort of redress our grievances. That's just simply saying, the sky is blue, right? In a system that is meant to serve that. Two, separate apart from no one's going to put good money after bad, right? In terms of fueling litigations. And even more so, I would say, in the bankruptcy space, because money and capital is scarce. You don't have enough money to run a business. So therefore the business files for bankruptcy and it's being, either reorganized so that the right size portion of the business exits bankruptcy and goes forward, or there's a liquidation and it's being sold for parts. And one of those parts could be litigation claims that it has, but the estate, if it can't even satisfy, the ongoing business, will not have the necessary capital to actually prosecute those claims. And those claims, more often than not, are left behind. And that's why bankruptcy estates are treasure troves for claims, for litigation claims, because it's always the premise of not having enough money to prosecute meritorious claims. And so
Right.
that I think is the sort of the white space that exists when it comes to
Yeah.
bankruptcies and litigations.
Yeah, and I think more importantly too, because even parsing out those kind of claims, I don't think you're talking about go through and see every contract the company ever signed and see if you can get 50 grand. We're talking about, we have claims in the Visa, MasterCard litigation, or we have claims. So in other words, I think, and tell me if I'm wrong, a lot of these are claims where there's MDLs or there's class actions already going, and that company has a piece of that. Is that I think that's where most of this is. So again, not not ginning up new disputes.
There's that, but there's also oftentimes when a company files for bankruptcy, something went wrong, right? So that's the premise, like something went wrong, something went awry. And so then the question is, well, what are the sources? And some of the typical targets for, sort of recovery on behalf of creditors, you've got D&O insurance. So
Right.
large pockets of D&O insurance, are there claims associated with that can be filed? Other things like, for example, there were standing litigation, the MDLs of the world, where if the company files for bankruptcy, it may not have the wherewithal or the focus or the capital to fulfill and get its recovery as a creditor in one of those claims. For example, a retailer would have a bunch of Visa, MasterCard claims. They may not be paying attention to those because they're paying attention to the fact that they're restructuring and undergoing financial distress.
Interesting. Okay. So we've talked about situations where there's some risk. You talked about these Peterson claims, or this bankruptcy, and there's this ongoing litigation against Argentina. So, one thing I hear a lot about, and so I want to unpack this is, you know, you generally get sticker shock. People are saying, wow, litigation finance is really expensive. Um, and so I kind of want to unpack that. So when someone comes to you in 2012 and says the sovereign government isn't giving us our money, and you have to beat them in U.S. court, and then you have to collect against them, and by the way, they don't have any money, and by the way, you're sitting against every bondholder in the world. Um, look, I don't know what those claims are, but my guess is expensive is maybe like in the eye of the beholder here. I mean, do you think that's kind of fair to say?
Absolutely. And I don't think in terms of expensive or cheap, but rather risk reward, right? So
Right.
think of it this way. If you don't actually, if Peterson didn't take the Burford funding, where would those claims be today? It certainly wouldn't be a 16 plus $billion judgment for sure,
It would have been
right?
TED PLC that you set up earlier. I think that's where they'd be in. We'd be in motion practice probably. I think we'd be sliding along.
Exactly.
But no, I
Um,
think that's right. Yeah.
Right. And I think when I think expensive, I always think of it this way, which not only should a funder be bringing to bear its capital, it's not, money is fungible, but rather bringing expertise, bringing partnership, bringing networks, and bringing ideas. So when I think of not all investors are the same, and also not all claimants are the same for the same, for that purpose. And when you think of it, it should be a partnership, right? And I think that's what, if you ask the folks at Burford, or if you ask the folks at Peterson, I think they should be pretty happy that they ended up working together and getting that deal done to get to the $16 billion judgment. Let's see if it gets reduced to, collections. That's a whole nother story. Ultimately, in terms of what you can do in terms of creating a larger pie. So I think that's the premise, where if you can create a larger pie by working together with the right funder, with the right litigants, with the right structure, with the right incentives, you're better off than, sort of a scarcity model of, here, I'm going to get the largest portion of the pie versus growing it. So I think that's why expensive is not the right term, which is, what's the most value accretive way out of this?
Right. And I think too, so, stepping back a little bit. So sometimes, law firms are themselves seeking the funding. Maybe they have one case or five cases. And, as an initial matter, I mean, the law firm model is a partnership, meaning that the cash that comes in the door for every 12-month period is meaningful. And so there is kind of this symbiotic relationship between law firms, which really need current income unless they're owned by literally, independently wealthy people who can float it. But then funds whose whole mantra is to get paid to wait and take risk. So, talk a minute if you can about, because I think this is why this is one of the many reasons that I love the business, is because it is symbiotic, right? You have these two different structured entities that have each other. So just what, I mean, what do you think about that? Am I sort of off there, or do you kind of see it that way, or what do you think?
I think you're exactly right. It is that complementary, symbiotic, complementary nature, right? When you think about in any situation, when it comes where's the right investment sort of complements goes, I need cash now, or I have a liquidity issue. There's capital coming in that's patient, that allows you to wait and transfers risks or allows you to extend the runway to restructure a company or to fully maximize your litigation claims. And here, that relationship between law firms and funders are very similar. Law firms want to grow. It's a business. It needs to pay associates. Associates don't take IOUs, and,
Right. Yeah. 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 Or they leave.
exactly,
And one
or
bad
they
year,
leave.
I mean, one bad bonus year, and they can literally, it's funny, you were talking about how money is fungible. In certain places, they can be doing the same job somewhere else, but the bonus was much higher, and it does become a real retention problem. I think you're right. I think you're right that it's just there's competition.
Right. And I think that litigation funders are another source of capital to allow a law firm to really scale and grow up and retain talent. And it's not meant to be hold your nose, this is expensive capital and I wouldn't do it. I think of it as growth capital in many ways.
Right. And it's also, let's talk about laying off risk, because sometimes I'm a little bit amused when huge law firms are trying to fund a deal and they say, oh, this is, an $8 million budget. And, they get the term sheet and they say, this is like super expensive. And I just say, well, hey, they did a UCC search. We know you have a secured line of credit at this huge national bank. Why don't you just borrow from there? Right. Well,
Right.
no, or hey, why don't you and the partners, just not distribute that 8 million, and they don't. So that, right, that's the risk transfer, right? And the lawyers don't want to hold the bag for the whole thing, and I get it. But if you don't want to hold the bag and you have the money, it's not going to be. It's not going to be. It's not going to be. It's like what you would get in a just commercial banking relationship.
Right. I also think what you're touching on, Ted, is a concept of moral hazard, right? So when you think about, why capital has to have certain costs associated with it and why litigation funders, not only do they bring money, they also bring capital allocation discipline, right? In the sense that dollars should be utilized in an optimal way to maximize returns on this investment. The investment goal is we are in this together to make a small bag of cash that was used to litigate and to seek justice, to get the right to right the wrongs, and to bring a big bag of cash at the end, right? Whatever that sort of mission and goals are, there needs to be discipline. And that's where the funding allows for a budget. There allows to be servicing as to make sure that the debt is serviced, but also keeping an eye and monitoring cadence. And that actually benefits the ultimate litigants in the long run.
Yes.
Because when you think about moral hazards, you transfer risks. Lawyers, may or may not have the right and the same incentives to maximize it if they don't feel the risk of, well, I'm not going to get paid if my clients don't get paid. And that's very important to share risks and to share the goals. And that's where the earlier we were talking about the symbiotic relationship. That's where I think the capital discipline that's imposed by litigation funding and actually eliminates what I call the moral hazard risk.
Right. And I was an antitrust lawyer by trade. And so when I'm working on an antitrust style deal, like I'm really in the nitty gritty. I remember I submitted a budget for something that in total dollars was, I think, one of the largest things I had ever done. And the funder's reaction was, wow, this law firm is going to spend 75% of this money on outside experts who help them win the case. So we think their incentives are wholly aligned, right? That money is a pass through. They don't make any there. They're really trying to look, they have to take some fees along the way. They have associates, everyone has sort of their monthly nut. But the reaction was, this pot of dollars is being directed to the highest and best use of driving this result. And so the nominal number was not a big deal because it was going to be directed, where it has to go to win, to win these things. And that's the goal, right? Is to win these things.
Right. And I also think that when you think about not just winning, it's a win-win in another way, which is it also allows you to take a step back and to really analyze whether this is a meritorious claim. Is it worth engaging in? And that exercise of budgeting is also a part of underwriting because it may be that you feel very personally, very strongly about a litigation, but the damages do not justify the duration. They don't justify the actual sort of money spent to get there. It may cost more to get there than warranted. So for that reason, that's another way, to say at the very end, if it doesn't get funded, those litigations do not go forward because not because they're not personally meritorious, but on an economic level, they're not meritorious. And that's, I think, the sort of the counter to when people say, well, all this money that's being thrown in litigation funding, it's like almost, fuel to the fire for litigations. And I think the answer is actually the reverse. You probably have less litigation going forward if you can't afford it and
Well, I
shouldn't
think that,
take it forward.
yeah, and I think that the Chamber of Commerce would be so disappointed if they realized how many cases end up not getting filed because people take a very hard look at it and it's 80% there, but there's something there that just says this isn't going to work, or there's some legal defense, that's sitting there. So when someone comes to you and, wants you to take a look at it, from a damages and collection perspective, what are you kind of looking for? Because people ask me sort of, what do we need to show now? I mean, we have a draft complaint. So like, what do you kind of expect to see? When you're start and look, let's assume it's someone you don't know. So like, you're kind of expecting it to be like, ready for prime time. What kind of things sort of give you comfort that something might be, that something might be, where you want to get involved in it.
So I think for me, it's a little bit different in terms of how I think about it. I would say that I think of it along the lines as collateral. I think of it as risk reward. I don't just look at a loan and say, hey, is this loan going to be great? What is the interest rate? What is the timing? I think of it as on the downside, I don't ever want to lose my principal. The question is, what is the options associated with this sort of collateral or the thing that I am investing in? And so for litigations, because there is that risk of loss, the binary risk, I like to make sure that if it's a binary risk, it's got to be very, very convex, right? Meaning, you know, the things that I like, probably different from what other people are out there. People will say, "Oh, I'll fund if there's like, 1 to 10 in terms of damages." I
Right.
don't follow
Right.
those rules. The kind of stuff I've done in the past and I've really liked and I've been successful doing is I look at something, it's 5 cents. I think that
Mhm.
there's probably 2 to 3 years left on this litigation or this time horizon. And I usually like 20 times or more in terms of risk reward on those types of situations. And you're probably thinking, well, how do you find those? Those are really, really hard to find. And I'm actually working on a couple of those types of situations now because they require that much in terms of a deep dive. That's the kind of stuff that you think about where it's the once in a year, once every 6 months, you see something of that nature. And it's not a lot of volume.
All right. So now we're going to talk about finding, which is my favorite part. You see, you call someone up, they said, how'd you find this? And of course, the answer is because I did, because that's what I do. But so again, I talked before how we're sort of coming up conference season, and a really good question that gets asked a lot. And then I'm going to give you my thoughts, and hopefully they're going to be so brilliant. You're going to say there's nothing to add. But the question does come out. It says, is there too much money chasing too few deals? And I think the answer is no, but I think what the answer is that there's too much money chasing the exact same deals, right? If it's credit, we want to do huge things where it's post settlement and the money's sitting in the QSF and we're just factoring, right? Or I want to do huge loans where there's 10-to-1 coverage and there's insurance and it's there. So, but do you think that's right, that a lot of people are just looking, they're all calling the same law firm? I'm just interested in your perspective on that, because obviously, like what I know about you and anyone listening who knows you, like you find and identify things that other people don't identify. So I'm just interested if you sort of share that perspective.
I think so. And the reason is this, it's the concept of crowded trades, right? You've got to be, whether it's litigation finance, whether it's distress investing, whether it's investing at large, whether you're looking at healthcare stocks, I think humans and investors fall into the trap of, crowded trades. And they like to do what other people are doing because they find comfort in that sort of herd mentality. And I think that's where I tend to steer away from, not because I just don't find them more interesting things. So that's why your point of too many dollars chasing the same deals, I think that's right. But that's not a litigation finance issue. That's a, you know, investing issue at large, because that's what the markets are like. That's the Mr. Markets of the world, right? It's
Well, hang on,
the
Cindy, I just
ultimate.
got an alert. Hang on, Argentina
Mhm.
just expropriated another oil company. Should we try to get that, or you think we just let everybody else call
Exactly.
about that?
They can do that. That's
Okay,
going to take a while.
we're not going
Um,
to chase that. Okay, we'll let
we're
somebody
not
else
going
go
to
get
chase.
that.
We
Okay,
don't
that's fine.
chase.
That's fine.
So when you
Uh,
think about, I think that's right. And I think the best ideas come from being, one of the things I didn't mention is, why do I love what we do? Or what it is, what investing is. You get to be so incredibly creative, and you get to learn a lot, like the entire spectrum of what it is that you can get really deep on and sort of understand. And that's where you find the opportunities. I think people are very happy and willing to look at surface level things. Oh, there's a settlement, so therefore we should raise capital just to deal with settlements. Those are interesting, but as you can imagine, the easy things to do, everyone will chase it, spreads compress, and therefore there's not a lot of returns. And then they wonder why there isn't, why you don't get a lot of alpha, because that's just how, investing works. The harder thing to do is to be really, really still and start learning a whole bunch of things. And all of a sudden, there's a couple of opportunities where you almost, to the point where you almost scratch your head, where it's almost too good to be true. It can't possibly be that this is like, 30 to 1 or 50 to 1. Those are the ones where that's when you start doing a lot of those types of work. And so I think that I agree with you. I think a lot of people chase the easy stuff, and they chase the easy stuff because that's what human nature dictates. But,
Yeah,
you
and
know,
by the way, I think they do okay, but it just gets harder to deploy, I think, is the problem, right? So those trades are great, and look, when someone calls me and says, I'm trying to place a post, that thing, that's great for me, because I know that there's a lot of people who look. But on the other side, like, for example, I've had the discussion with multiple credit funds in the last year saying, we wish we were doing more of these judgment preservation policies. We'd love to lend on those. And they kind of say, well, what are we doing wrong? And I say, you're not doing anything wrong. 25 people are looking at those at the same time. And so, the fact you only got one this year doesn't mean your pitch is wrong. It's just that, though there's a lot of money, lined up to get those done. And again, nothing wrong with that. And, if you're charging what you're charging, your LPs are happy, that's great. But, as someone, looking for interesting stuff, there are a lot of people chasing the stuff that is, I would just say, relatively straightforward, right? That's how I would sort of look at it.
yeah, it is relatively straightforward, and I think that's what people don't realize. You can't get a premium for commodity, right?
Right.
It's not differentiated. So, and investing is hard. Ultimately, when I think one of the hardest, most interesting things you can do with your career is to be an investor. It is completely unknown. You don't punch in, punch out. You don't do zero point 0.1 hours and know that this is the same sort of track that you're supposed to be on, that you go from a first year associate to a second year associate. It is completely, quadratic, and could be parabolic, and it could be disastrous in so many ways, which is why it's so interesting. And that's where I think the opportunity set lies, if you're comfortable with being, as someone has said to me recently, uncomfortably correct. That's
That's a great way to put. No, that's a great way to put. And it is interesting because when you're talking about finding situations in time, like, for example, I'm assuming you don't write down your key performance indicators for the week, that you made this many phone calls and did this with your CRA, right? I mean, that's just sort of not the nature of it, I think. So okay, so I guess the last one, we're sort of at the end of the year. And so, at the beginning of the year, there's all the think pieces, where's the business going, and then sort of what's happened. What do you sort of see, where do you kind of see the market now, and kind of where we're headed, and just like big picture? And this is not like to say, you're the sage with the crystal ball, but it's just interesting to just get your sort of thoughts on it.
No, not a sage with a crystal ball, but I think live long enough to see that. I think anytime you see a whole bunch of capital going somewhere, people make mistakes, and so therefore there are opportunities to be on the ready when things fall apart, and you can buy them very, very, very cheaply, and then be willing to put in the work to unlock value. So things that I
That's the
see,
word. That's the second part. A lot of people, no, but for real, like a lot of people will buy cheaply, right?
yes.
And so you have X dollars out. I'll come and senior to you for this. But then, of course, it's the same problem 12, 18, 24 months. But I think it's that second piece you mentioned about the work, is really interesting. And, look, the people who sort of listen to this podcast, like there's a lot of people in the business, but then there's people looking to get in. And I think that's the hardest part to learn. Is closing the deal is great, but it's not the end, right? It's the end of the beginning. And I think that's just sort of a key lesson for people.
Right. And I would say I think of it as sort of end of year. I've done some of the most interesting deals towards like always during the holiday seasons, because people want to get out, they're fatigued. So one of a great investment I did was to do a distress buyout of a loan that accreted way too high relative to the value of the collateral, and the litigation lawyer there couldn't catch up in terms of the amount of inventory. So that type of opportunity, I think, is going to be available. Call it again. You buy something out at a significant discount, and then you don't just sit there and let it accrete again. What you do is you then do something different. You restructure it, and then you monitor it, and then you make sure that it actually pays out. That particular loan that I did, I bought it at at 30% at a 70% discount to value, and then ultimately structured it as a 4-year loan, and I got it to pay out from a small bag of cash to a ultimate much bigger bag of cash in under 3 years. So that's the type of
And of
stuff I
course, the
think
loan
there's more
pay,
of it. Of course,
yeah, and
yeah,
of
that's
course, the loan paying out is good for the borrower,
yes,
because the borrower can't make any money until. So like that's the forgotten piece in this is, had you not come in, I mean, I don't know if there's a law firm, we can talk about offline, but like, the
mhm,
project would have been over, and it would have
right,
been a zero, and the clients are left in the lurch. And so, the restructuring sometimes leads to a successful outcome for everyone. So you make a great return, but they get to, sort of like achieve what the achievement was. Right, the original loan was taken out not so you can say you have a lot of debt, but was to get somewhere. And so I think that's sort of an important piece here. Um,
yeah.
this has been great. I'm going to give you the last word. Anything else, or anything else we want to cover? Or are we good?
No, this was wonderful, and so glad you're creating a platform for people to talk about litigation funding. I think it's such an important asset class. I think the correlated nature of it will be very important, but it's just another set of tools for special situations. And I love to see more creative and interesting things come along from many participants and more participants in this space. Thank you, Ted.
Awesome. Well, thank you so much. Great to see you as always. We'll talk soon.
Okay, thanks. Take care.
Bye.